I won't tell you what the future value of gold is. However, the DXYN 2027 to 28 at 50 would be half of today's level if our technical analyst is correct about the US dollar index, DXY. And if that's the case, the price of gold will likely double. Supply chain resilience and adaptation are no longer optional. They are required in the new era that the dollar's decline and gold's ascent herald in 2025. The investment bank projected that if 1% of the privately held US Treasury market were to pour money into gold, the price of gold would increase to about $5,000 per ounce, according to a big study that came out this week. That's 42% more than where it is now. Gold is expected to surge to $200 next month, according to market expert, before a downturn occurs in early 2026. As a huge investment, Simon Hunt thinks prices will go up to about $2,800. In the future, he predicts that the price of gold could rise significantly from its present level if the US dollar index continues to decline. We have entered the storm's eye. By mid-2026, US 10-year treasuries will most likely be trading closer to 3%, forcing the Fed to lower long-term bond yields. Some relief has arrived. Simon Hunt predicts another huge inflationary spike, similar to the one in the 1970s. When borrowing costs soar into the double digits, asset prices will plummet and kick off a worldwide financial catastrophe. The traders have clearly defined their front lines. With S&P targets reaching as high as 7,000, some predict dramatic cutbacks will continue into early 2026. Sticky inflation, according to some, might limit the Fed's ability to act quickly and force a slower pace. The dollar's decline to its lowest level since July has increased the likelihood of a wider rotation into commodities, credit, and gold. A significant downturn in the market is imminent. As the US Treasury withdraws $580 billion from the system, Simon Hunt predicts a 15% market correction by the end of the year. There has been an extraordinary setback. It serves as a signal shot. In order to ensure that you never miss a moment when the truth meets the market, be sure you hit the subscribe button and push the bell symbol. Then we will dive into Simon Hunt's insightful discussion with Mario Inco. There is a lot of sensitivity in the world's financial system. To facilitate the Fed's large refinancing, it is in the best interest of the world's leading central banks to lower the yield on long-term bonds. According to our technical associate, 10-year treasuries could rise slightly from here in the near future, but by mid-2019, we expect them to be closer to 3% than 4%. At that point, underlying inflation begins to rise at a higher rate than underlying growth, a phenomenon known as an inflationary takeoff, which is nearly stagflation. Therefore, long-term bond yields in the West will be in the double digits by 2027 or 2028, and 10-year treasuries won't be trading at 4% or 5%, but likely above 10%. Reason being, things are going to revert back to how they were in the 1970s and 1980s. Inflation spiked in the mid-1970s, then fell. Now we're in the same bottoming out phase, and prices will resume going up in the second half of next year, just like then. Yeah, the problem then becomes what happens to the world's economy and financial system when bond vigilantes demand a premium despite double-digit inflation. Therefore, asset prices around the globe will plummet as a result of that. The financial system is about to collapse because to yields in the double digits. To sum up, that is the situation we are witnessing. In the following month or two, I predict that gold prices will rise another 200. After that, I believe a decent correction is on the horizon, and it might coincide with central banks meddling in the bond markets, which would have a domino effect on gold. As a result, I anticipate a huge drop by year's end, and I'd venture to suggest that we could witness gold at 2,800 in the first half of next year. After then, it's a huge purchase. Inflation will rise and geopolitical tensions will intensify, so it's a good time to stock up. I won't tell you what the future value of gold is, but if our DXY technical analyst is correct, the DXYN 2027 to 2028 would be at 50, which is half of today's level. And if that's the case, the price of gold will likely double. According to the specialists I consult, the Treasury will be siphoning off $580 million or even $1 billion from the system due to internal reasons. As a result, a correction is inevitable in the markets. What worries me is that the markets have been driven higher by the retail sector and not the big institutions. I predict a nice correction, maybe 15 or so %, before the year ends. Resuming our previous conversation, my concern is that a deluge of European funds will leave the continent in favor of the Ukrainian army if Europe does intervene in Ukraine. Large funds have likely already begun, but Europe will impose capital controls the moment the gun goes off. What will happen on a worldwide scale if, due to the interconnectedness of banks, Europe implements capital controls? If this is so, and if Israel is, as appears likely, getting ready to launch another attack on Iran, and Iran is getting ready to do more than just defend itself, I may argue that the world is not merely changing, it's being torn apart. A multipolar system, spearheaded by Russia, China, and India, is displacing the US-led order, which is failing. Russia is seeking stability in Ukraine for the long haul, but her comments about Taiwan indicate a definite preference, disagreement, or discussion on our terms. Simon Hunt claims that members of the BRICS and SEO groups are sick of US diplomacy, and that even Iran thinks that talks with Washington are pointless. There has been a shocking erosion of confidence on a worldwide scale, and the prospect of a dramatic escalation is now very real. Putin, Modi, and Xi were all present at the most recent Shanghai Cooperation Organization (SCO) meeting, where leaders from various philosophies found themselves unexpectedly on the same stage, conversing in a language of unity. Although new competitors are joining the fray, the dollar remains king. Interestingly, it's possible that Donald Trump is the one who gave them the push. Civil unrest is putting the UK on a collision course, even though US support could provide a temporary boost. There will be significant market corrections within the next 6 months, according to Simon Hunt. However, that timescale could be accelerated, extending the situation until 2026, if Europe's actions in Ukraine intensify. Now, we may return to the interview. The beginning of September marks the anniversary of the commencement of World War I. World War II. That was 86 years ago, which is, according to Strauss, who penned The Fourth Turning, roughly 80 to 100 years ago. Therefore, a major conflagration is probably on the horizon. I was wondering, what are your thoughts on the likelihood of a big war breaking out? Worst case scenario, a big war breaks out, and the European Union member states of Germany, France, and the United Kingdom show no signs of wanting to negotiate a peaceful resolution with Russia. They continue to provoke Russia, if anything. It was reported that Merz compared President Putin to the deadliest dictators and murderers in history. I suppose the Russians were not pleased by that. Not at all. All right, let's look at the broader view. Here we have the current standoff between the United States and the multilateral world, which includes Russia, China, and, most recently, India. Based on my observations, the most important takeaway from the SEE, the Beijing bilateral meetings, and the military parade is the determination of SEO members, many of whom are members of the BRICS, to take a firm stance against any actions taken by Washington. Thus, for example, Putin will not budge from its demands regarding Ukraine. And I believe that Moscow's future long-term security is probably their biggest concern. And that means they need some kind of control over all of Ukraine, because the United States is likely to develop hypersonic technology or something similar in the near future, and drawing a border at the Dnieper River won't give them enough radar warning of any approaching missiles. As a result, I'm putting my money on them taking control of Kiev and Odessa before declaring, now we are prepared to negotiate, and offering their conditions. The message was quite obvious while reading President Xi's remarks to the troops prior to the military parade. Because it was truly about reading between the lines, it was either accept what we want or there would be conflict. I sent a note with the key citations this morning and will email it to you. Since I saw them as essentially stating, let's come together in dialogue with mutual respect, or else, I will provide you the quotes themselves. The major SEO and BRICS nations have had enough of Washington's diplomacy, according to one message that has emerged from this and other summits. It does nothing. We have given up with negotiating with Washington, declared an Iranian foreign minister, among others. It serves no purpose. I should expect the same from Iran's leadership if that's what they think in Russia. India, China, and Russia will all experience the same thing. From my vantage point as an outsider in Dubai, looking down on the UK, I predict that the stock markets will soon recover, helped along by American and American-affiliated major financial organizations, but that the country as a whole is heading straight into civil war. The stock market may experience significant corrections in the coming 6 months. The bond market is delicate. However, that 27-28 era will see the great crash. Everything that ought to happen in 27-28 will really happen in 26-27 unless, and I repeat, Europe physically invades Ukraine. My final conclusion is that, according to your expectations, there won't be a major disagreement anytime soon, maybe next year or in 2 or 3 years. Therefore, bonds mitigate negative risk, stock prices rise, and gold has become the mediator of mistrust in the market. The outcome of this divergence in terms of a soft landing rebound or stagflation fears will be determined in the days to come. The prospect of further rate easing by the Federal Reserve has been and will continue to have an impact on asset prices and the US dollar index. Amidst these changes in leadership and growing financial tensions, the US dollar index dropped more than 10% this year, reaching 97.36. Rather of waiting until it's too late, would investors take immediate action to safeguard their assets? Leave a comment with your ideas. Please consider subscribing to our channel and enabling notifications so you never miss an instructional video like this one. I will see you in the video that follows.